UBS released their Global Real Estate Bubble Index again, showing us the cities with the highest bubble risk all over the world. Man, I'm looking forward to this one. Especially because there are 2 German cities among the top 4 worldwide with the highest real estate bubble risk. You guys guessed it, Frankfurt and Munich. Let's see some details why UBS put Frankfurt and Munich up there and how valid the Global Real Estate Bubble Index is in the first place. Because if you're living in one of the 2 cities and I'm living in Munich, you might have a different perspective on this. All in this episode of the GermanReal.Estate blog. The first sentence that opens the UBS Global Real Estate Bubble Index is, in many cities there is not enough housing supply. I like that one a lot because that is especially true for German cities. And that is also one major argument why there is no real estate bubble. Because in order to be a bubble, you need supply that is far above the demand, so prices fall. Why is UBS talking about a bubble then? 2 factors, rents and financing. Let's look at those one by one before we come to Frankfurt in particular. UBS looked at the development of rents versus the development of property prices. In all major cities they looked at, property prices have been going up and up for the last decade, sometimes even by double digits. What about rents? Rents increased as well, but only by a little bit with local salaries. If property prices increase by a lot and rents increase only by a little, the profitability of real estate is going down, making it harder and harder to justify the high property prices. UBS calculates this with a prominent price-to-rent ratio. How many years do you need to rent out a property until it pays for itself? And the undisputed king of the price-to-rent ratio is my city, Munich. It's actually not that great to be number 1 here. While a flat in Munich had a multiple of 30 10 years ago, meaning a flat needed to generate rent for 30 years until it paid for itself, we're at 44 years today. And Frankfurt is not that different with a multiple of 27 10 years ago and 42 today. 42 or 44 years is a long ass time until a flat is paid off. So maybe investing in real estate security tokens on our GermanReal.Estate marketplace is better for you. At least you don't have to wait 40 years to make a return with our security tokens. What are high price to rent ratios telling us? That investors are willing to sacrifice return from passive rental income in the hopes of rising property prices, which UBS argues is driven by one major factor: historically low mortgage rates. Central banks around the world have been printing money like crazy while decreasing interest rates to basically zero. When central banks decrease the monetary value of money by printing it, investors save their money by investing it in real assets like real estate or stocks. Luckily, central banks cannot print real estate or stocks yet. Now interest rates are rising again for a couple of months. Almost 4 times as much as they were just a year ago, increasing the costs to buy or own properties. Rising mortgage rates are rising costs, which should lead to falling real estate prices. That's at least the argument from UBS, which I'm not sure I can agree 100% with. Rising mortgage rates are not that great for real estate, don't get me wrong. But when we're just looking at mortgage rates, as if they're some isolated thing standing alone, detached from any other factor, I think we're getting a pretty incomplete picture. What about inflation? What about alternative assets for investors other than real estate? What about the real income of people? There's so much more to look at than just one single factor. And when factoring in inflation, we can see that the property prices in Frankfurt and Munich went up nominally, but in real value, adjusted by inflation, the prices went down a couple of %, which is fine for investors, right? The higher the inflation, the higher the nominal value your mortgage is going down as well. One of the 7 A cities in Germany, Frankfurt, got its own page in the UBS Global Real Estate Bubble Index, titled Slowdown in the Making. In the annual growth rate chart, you can see that Frankfurt was the big winner of the Brexit, with a lot of high-paying jobs moving from London to Frankfurt. Now this growth has gone down over the last 2 years and is expected to be at 5% only this year, for the first time below the 20-year average growth rate. UBS argues again that property price increase has to slow down at some point as rents didn't keep up. We've seen the price to rent ratio earlier. But at the same time, they say that vacancies are extremely low in Frankfurt, which could mean that property prices rise even higher. UBS argues the housing shortage in Frankfurt will resolve itself in the next years, which I highly doubt, given how much living space Germany is actually creating. We're not creating anything actually. Germany is losing 100,000 flats each year. So I can only agree with this Instagram comment that was posted below the UBS report. And that shows you how complicated the real estate bubble question really is. Is it a bubble? Or is it not? And what do you think? The full UBS bubble report is linked in the blog post on our website GermanReal.Estate if you would like to deep dive into the global real estate bubble discussion. And when you think real estate is an exciting investment and you're on our website anyway, why not check out what investments are currently available on our GermanReal.Estate marketplace?